David, I'll start with you, if I may. The S&P's up 2.2%. It's over 20% off its lows. What do you feel is sort of fair value for the S&P at the moment?
Market's certainly up quite a bit from its lows, and it happened really quickly, almost as quickly as we fell into a bear market. Look, I welcome the enthusiasm and the solidarity that equity investors are showing the world and the altruism. But I think the equity market is well ahead of itself. I think equity investors are kind of driving blind in a really risky environment, a very curvy, dark road, and they're just haven't taken their foot off the accelerator here. So, look, I think fair value for the S&P in this type of environment, it's best to talk in ranges. I think immediate fair value is 2,000 to 2,500, maybe 2,350 as a spot estimate. I do think we can be at this level, maybe slightly higher by the end of the year. And I think we get to maybe 3,000 on the S&P at the end of 2021.
That's an interesting forecast with us at 2,700 or so at the moment. Jurrien, even if the data does continue to improve, which we all hope it does, in terms of the virus itself, what do you think the market is pricing in terms of the economy at the moment? And is there a risk that it's hoping for too quick a rebound?
Well, look, I think
go ahead, Jurrien.
That is, of course, a risk. I mean, it seems unlikely that we're going to get the V-shaped recovery that the earnings estimates are pricing in, right? If you look at the next sort of 6 quarters of consensus earnings estimates, not that those mean a lot right now, as companies have pulled their guidance as they probably should, because it's an unprecedented shock to the system. But if the V turns into more of a swoosh, then the earnings estimates, the outlying estimates for later this year or next year, probably need to come down. But if you look at sort of there's an S&P 500 dividend futures contract, and a few days ago it was trading from 61 down to $40. It's up to 44 now. If I plug that number into a discounted cash flow model, I'm actually getting to around 2,500 as a fair value, given where rates are and where the equity risk premium is. So the market is not too over its skis, I think. It's just, a lot of bad news was priced in when the market was down 35% a couple of weeks ago. So I think the market is actually in an okay place. Ironically, it's down 20% from the highs at today's price, and it's also up 20% from the lows. So we're in that holding pattern, that base building mode. And I think really the risk is that the market won't be able to rally as sharply as we'd all like if the V really does turn into more of a swoosh and the earnings rebound doesn't happen because the economy doesn't come back online quickly enough, or maybe there's secondary waves of outbreaks or something like that. So I don't see it necessarily as downside risk from here, rather than a lack of upside potential and how fast the market can regain its footing.
David, do bonds still have a place in a portfolio if you're constructing a fresh portfolio today, or have they already done their job, as it were?
Bonds have a bigger spot in the portfolio than ever before, in my view. Not so much long-term treasuries, but especially corporate credit. I don't see the risk-reward as attractive for equities other than large cap tech stocks, essentially, the virtual and the essential businesses. But corporate credit is acting a lot more rationally. It's taking risk, but it's pricing the risk better. And I actually expect that the corporate credit investor and banks are going to be what saves this economy. And I think it's the corporate credit investors are going to reap most of the reward from that. Now, you may be thinking, how's that going to happen? Many of these troubled businesses are going to get rescued by creditors, but at terms along the lines that if things get worse and there are defaults, those credit investors will become the equity investors.
Jurrien, clearly coming into this crisis, U.S. equities commanded a significant valuation premium over other developed world indices, particularly the likes of Europe. I mean, PE multiples are slightly out the window at the moment, but when we come through the other side of this, do you think that will come back again with a big premium for U.S. multiples over European multiples, or not?
That is really one of the big existential questions in terms of strategic allocation over the next, not year, but the next 5 or even more years. Europe and Japan are countries or are cultures and economies that have generally favored sort of labor over capital. And I wonder now that the U.S. government, both fiscally and through the Fed, now that they are taking a much bigger foothold in the economy with all the stimulus and the relief that's now being put into place. I wonder if we will start to see a shift a little bit away from capital more towards labor, especially if the financial engineering era has kind of gotten maxed out. And I think one of the reasons why the U.S. has commanded a multiple premium over Europe and Japan, it's sector composition, right? Europe is banks, and those are a lot cheaper, especially in Europe. But I wonder if it's also this focus on capital versus labor, where the U.S. has been much more shareholder focused. And so if we start to see a shift in that, maybe that PE dispersion starts to narrow. And if you add to that a weaker dollar, which, given the aggressiveness of the policy response in the U.S. relative to at least Europe, maybe a weaker dollar will also help that sort of currency translation aspect.
Gents, we'll leave it there. Thanks so much, Jurrien Timmer and David Bianco.